Hey, welcome back to another episode of Asset Coach and Tax Strategist. As you can see, my background is looking blank. We're in the process of moving, so very excited about that. But wanted to go ahead and give you more information on another episode. And this episode here is visualizing the assets and liabilities of the U.S. banks. I know there's been a lot of conversation over the last few months with some of these banks going under, and it's causing some concern, or has, and so I saw this on Visual Capitalist, and I thought this would be interesting to go through and kind of dive into it. So, by the way, let me comment on us moving. It's not a bad thing. I know we just moved a few months ago, but some of the other companies that we own are growing, and so they need space, and we all need space. And so we've been blessed to where we need to go into a position to where we need to expand. So if it seems like we keep moving, it's because we do, or we've had some significant growth over the last 3 years. Which has been great. And one of the things that you've seen grow is our YouTube channel. We also have a podcast called Farming Assets. So if you want to check that out, it's on Apple and Spotify. Different content than here. We don't cross-pollinate content because we're trying, the people who are producing our podcast, they're looking to monetize it, and they don't want to cross-pollinate YouTube viewership and podcast listeners. And so we have the two. And so if you want to get some more information, there's some more information over there. They're about 10 to 20 minute long podcasts, just like here. We drop every week. So let's get into this. So let me go ahead and share my screen here and dive into this. So this is from Visual Capitalist. And we're going to look at the visualizing the assets and liabilities of U.S. banks. Now, what I like about some of these is that they give us a nice picture that we can look at, but then also there is a article and more of an explanation. So we'll dive into that here in a second. But let's look at some of this. So U.S. banks, this is the start of 2023. There were 4,127 insured commercial banks in the United States. Here's how their collective balance sheets break down. So this is everybody collectively, all the assets. There's $22.9 trillion and 20.7 trillion liabilities. So assets, liabilities. Okay. So let's see here. Let's go. You want to go with the debts? Let's go with debts first. Okay. So let's not all right, so deposits, you're going to look at this and go, deposits? Why is that in liability? Because a deposit is a liability for a bank. The bank doesn't make money unless the money that you deposit in the bank is put into other assets. They loan it out. They make money off of it. So deposits, cash, is kind of considered a debt. So a liability. So other deposits include deposits like demand deposits, so checking accounts, saving deposits, and time deposits. Large time deposits are of 100,000 or more. Total deposits peaked at over 18.1 trillion in April 2022 and have since declined by around 5% to $17.2 trillion. Large time deposits is 1.8 billion. Borrowing is 2.4 billion. Other liabilities are 747 billion, and 298 billion are net due to related foreign offices. So these are deposits, 15 billion, 15.3 billion, so 15 trillion. And then all these here, these are the considered liabilities in orange. Okay, lending. So now let's look at securities. Let's look on the asset side. So let's start from the bottom, securities. Let's see here. Securities are considered treasury and agency securities are debt instruments which can be classified as held to maturity, so HTM, available for sale, AFS, or trading securities. Securities provide stable income, but can incur unexpected losses if liquidated early. Okay, so Treasury and Agency of 4.1 billion, which is 4 trillion. Let's see here, 4.1 billion. Other securities is 1.07 billion. So that's security. So not too exciting. Let's go to light blue. Loans to commercial banks, 6.5 billion. Total federal funds sold and reserved, 633 billion. Cash assets, 3.05 billion, and trading assets, 1.8 billion. Okay, so and now here's where the lending happens: loan and leases. This is where they make their money. So you got commercial and industrial loans at 2.7 billion, residential 2.5 billion, commercial real estate 2.8 billion, credit card and revolving plans 977 billion, other consumers 896 billion, and all other loans and leases at 2 point some change billion. Now let's look at this: commercial industrial loans and commercial real estate loans. Okay, look how large those are. Okay, so remember what I've said before is that businesses tend to get a lot of information from banks to lend money. So you got 5.5 billion. That is all within the focus of what? Now, when we talk about this is really trillion, okay? Because they're putting a comma here. So see this comma? It's not a point. So I keep saying point, but I apologize. I'm wrong there. It's not a point. This is trillion. Okay, you add all this up, and it's going to reach out to 22 trillion. Okay, so look at this. So this is all business, residential, and then credit card. So this doesn't say whether it's credit card or for business or not. It's just lumped in together. Okay, so 5.5 versus 2.5. Okay, pretty significant difference. This is interesting. So let's go ahead. So understanding the assets and liabilities of a bank, the U.S. bank sector has more than 4,000 FDIC insured banks and play a critical role in the country's economy by securing, storing deposits and providing credits to other loans. This infographic visualizes all the deposits, loans, and other assets, liabilities that make up the collective balance sheet of U.S. banks using data from the Federal Reserve. Okay. With the spotlight on the banking sector after the collapses of Signature, Silicon Valley Bank, and First Republic Bank, understanding the asset and liability that make up banks' balance sheets can give insight into how to operate and why they sometimes fail. I don't know if they sometimes fail. I'm sure there's more banks that fail than that's advertised. But because we had a string of Signature and Silicon, these were up in the Bay Area. The Silicon Valley is having a real tough go of it. But let's look at assets, the building blocks of bank's business. Assets are the foundation of a bank's operation, serving as a base to provide loans and credit while they're generating income. A healthy asset portfolio with mix of loans along with long-dated and short-dated securities is essential for the bank's financial stability, especially since assets are not marked to market, may have a lower value than expected if liquidated earlier. Okay, so this is just explaining what it says down here. Okay. Loans and leases. Oh, let's see. What's mark to market? So it said mark to market. Means current market prices are being used to value an asset or liability on a balance sheet. If securities are not marked to market, their value could be different once liquidated. Okay, that makes sense. Loans and leases. Loans and leases are a primary income generating asset for banks, making up to 53% of the assets held by U.S. banks. Real estate loans for residential and commercials, 45% of loans. Okay. Commercial and industrial loans for business operations is 23%. Consumer loans, which is personal needs, credit cards, auto loans is 15%. And then various other kinds of credit, 17%. Okay. Securities make up of 23% at 5.2 trillion. Banks primarily invest in treasury and agency. Held to maturity are securities which are held until they mature and provide stable income, available for sale, that things that are more liquid that are available that they can sell. Let's see here. Along with treasury and agency securities, which make up the significant majority of 80% of U.S. bank securities, banks also invest in other securities, which are non-governmental issued debt instruments like corporate bonds, mortgage-backed, asset-backed securities. So as you can see, banks put a fair amount into securities and agencies, because where do they get this money from? From the Federal Reserve. So what do banks do? The Federal Reserve. So you have the Federal Reserve. They send money to the banks, right? So bank reserve. So Federal Reserve prints, sends money to banks. What do banks do? Banks now they say, okay, so we have the United States, right? So we have the United States. Okay, poor picture of the United States, U.S., and banks now put money into securities. Okay, so treasury securities. That's essentially what happens. Boom. Now, what does the U.S. do with this money? Well, they spend it. They put it in their budget, right? And in return, they have to pay an interest to the banks. The banks pay a lower interest to the reserve, and then that's how the money flows in the economy. So when the reserve prints more money, there's more money that comes through. Let me do this. When they print money, there's more money that comes through. The banks have more money, so they'll put more money in here. What will they also do? They'll lend to who? You and I, to the U.S. citizens. And then what do? We pay an interest rate. So pretty simple. So banks make money on this interest rate here, right? So let's get rid of this and let's do this. So boom. Banks make money off that, make money off that, and they pay a small interest rate for the cost of the Federal Reserve. Okay, and that's how the U.S. economy flows, the cash flows. Let's see here. Deposits, borrowing. We're not going to go into all that. The rest of this is, I mean, we went through the visual. I think that goes through it pretty much everything. So anyways, it's a short video, but I thought it was interesting. I like seeing these visuals. It's helpful to kind of see where banks do. So you're sitting there and going, well, how did these other banks go out of business? Well, their liabilities were too high. I hate to be obvious, but their liabilities were too high, and they didn't have enough. They didn't have enough return on the payments of the liability. So whether they were businesses that went under or couldn't pay their bills anymore, who holds that bag of liability? The banks do. And if you get enough of those, it could cause your balance sheets to not look so great. And you got to make a decision. And you have all your normal bank overhead or business overhead, locations, you have payroll, right? You have all the other stuff to run a business. So you have non-payment of loans back after you take that risk. With interest rates, maybe they held on to too much low interest rate and didn't have enough liquidity to get higher interest rate returns on securities and treasuries. So there's a big issue, but I don't know. That's probably something you can go Google and look up and find out what the issues were. To me, I did not do a lot of research on that because quite honestly, it wasn't a priority in my business and running my business and how we run my business and help our clients. Maybe I should look into that a little bit more. And so, and if I do, and I find it in some things intriguing that I feel like I should share, you'll see an episode in the future on that. So thanks for attending and joining us. And remember to subscribe and like our information, our video, and we'll see you on the next week. All right. Thanks, guys. Bye-bye.